Hey, good morning, everyone. Marty Mazzora here. It is Friday, the 23rd of May, 2025, with your weekend update or end of week update. I will keep it pretty quick today, going into the 3-day weekend, but I do want to touch on what I think are, key, important subject matter that we need to stay abreast of and continue to talk about. So first, I'll tell you what the markets are doing today. As I speak, the equity market in the U.S. is down. The Dow's down 242 points. It was down closer to 400 a little while ago. The S&P is down, just 0.2%. It was down well over 1% a little while ago, and the NASDAQ is still down close to 1%. The yield chart in front of you, that's the 10-year yield. Notice this big whopping decline that we saw early in the session today. It's battled back considerably, but still down on the session. So the weakness in yields and the weakness in the stock market came on the heels of President Trump saying that he would like to, or is threatening to put 50% tariffs on the European Union. Now, with all that we've experienced the last few months, you might expect the market not to be so reactionary to such news. But in a sense, probably good that it is, because clearly the markets forced a real capitulation with regard to the Liberation Day tariffs and the tariffs on China. Probably more the bond market and yields than the stock market. Now, a 20% decline in stocks is nothing small, but a potentially hemorrhaging U.S. Treasury market is something massive from a systemic perspective. And make no mistake, that would lead to a whopping crash in the U.S. stock market as well. And as I'm sure you know, and probably don't need me to tell you, that the size of the tariffs that were threatened on Liberation Day would force a whopping global recession. The 30% tariffs on China, which I don't believe will stick, I believe are quite recessionary. A 50% tariff on the European Union would indeed be recessionary. And by the way, it's not going to happen. I can say that with a great deal of confidence. But just the fact that it was said, and just the fact that it was thrown out there, and just the fact that the president is still willing to threaten such things, you can see the big decline in yields. Now, why would that happen? If tariffs mean rising prices, that would be inflation, right? And therefore higher interest rates. As I said the other day, the tariffs are, in my view, disinflationary or deflationary, and the market certainly agrees with that. If indeed we were going to go that direction and force a recession, yields are coming down, ultimately with the economy. And again, given where we've come so far, you could be surprised that the market reacted to it, but you might say, good thing that it did, because if it is indeed the market that is causing hesitation in the administration with this particular strategy, well then this particular strategy, which would force a recession, which would be very ugly for folks, obviously, doesn't get to happen because the market will punish that. Now, forget about the tariffs, forget about the trade war, forget about everything else. We are sitting with stocks, for example, at very near all-time record valuations when we look at virtually all, or certainly most, valuation metrics, in my view. So I talk as if recession would be a horrendous thing, and it certainly wouldn't be fun, make no mistake. It is part of the cyclical economy, and I still do believe in the business cycle. We go through periods of expansion where folks get silly, things get frothy, things need to come down. We need to have a contraction, just like we need to have winters to make everything right on Earth, right? So in cycles, you have expansions, you have contractions. The problem with contractions is when they happen on your watch. If you are a sitting politician, you desperately try to pull every lever conceivable to keep that recession from happening. And that's just the world we live in, good, bad, or indifferent. Now, if we don't have recession and we don't allow cyclical phenomena to play itself out, then we continue to expand, or we stay at a certain level and just continue to get fatter, or so to speak, and a little less healthy incrementally. We don't get inflation under control. In fact, we bring inflation back. So I actually think that the administration is really counting on the spending bill to be an effective offset to the negative impact of the tariffs. Now, we're going to end up, I'm pretty certain, with 10% across the board tariffs on virtually all U.S. imports, which is not a small thing. Probably not recessionary by itself, but the ancillary effects, as they did in the 1930s, are what could bring on something very ugly for the global economy. So if that's going to be a weight on the economy, say the U.S. economy, well then fiscal stimulus, right? Government spending, tax cuts, et cetera, that are not remotely paid for by spending cuts, by the way. And it's front-loaded with the stimulus, back-loaded with the spending cuts. And you know how that works out. Just wait till it's time and let's see what the politicians do. So unequivocally, it is a budget deficit expansion bill as well. Now, budget deficit is a private sector surplus, as I've talked about. So typically the economy loves it. Typically the markets love it. Here's the problem at this juncture, and this is why I said in the last video, we're kind of between a rock and a hard spot here, is the level of interest rates right here and the level of inflation. If we don't have something that brings them down, like a slowdown in the economy, then they don't go down. Obviously, they go back up, and that's problematic. And then we get back to a 2022 scenario where the market tanked 27% on higher inflation and rising yields. So this is just a tough spot, folks. There's no other way to slice it. So clients, we're just kind of going to keep doing what we're doing. Ironically, today, while the stock market is getting hit, our core portfolio is up better than 0.25%. Why? Well, like I said in the last video when we talked about gold, the technicals still look bearish to me. But I said next week, if we get some fear, particularly in the equity market, we could see gold rally, and it's up 2% today. Now, we're still hedging it, which means we're only up 1.8% because the hedge is losing money, but we're going to keep that hedge on for now. The other thing that's working for us fabulously today is our uranium miners exposure. It's up over 10%, and that's because the president said something very bullish on behalf of the nuclear energy space in terms of promoting or facilitating more nuclear power in the U.S. Today, it's not a huge position, but it's making a difference in the portfolio. At the same juncture, Europe's getting crunched. Our European exposure is, we have two different ETFs. One's down 1.33%, one's down 0.4%. U.S. staples are holding in there okay today. Emerging markets are doing okay as well. And I think as long as the markets stay up, and a couple of days ago, the S&P was positive on the year. It's not now, but it was positive on the year. It's probably flat right now. Then it just kind of emboldens the administration to go back at it. So while people thought it was pure capitulation, me too, but we did wonder about Europe because we haven't gone there yet, and he was threatening to go there. So this news was just a huge shot across the bow, trying to get Europe probably to come to the table a little more favorably than maybe what they have thus far. And European stocks are taking a hit, as are U.S. stocks, as I just presented to you. Now the Dow's down a little over 300 points. So it's just kind of been bumping around in that neighborhood so far today. Okay, so I think you get it. Just to kind of sum all that up, that whole rock and a hard spot narrative is just that if we don't have a recession, interest rates stay high, probably go higher, particularly if they throw a bunch of stimulus in it. And if the tariffs are a weight on the economy and we don't have a recession, and then they do this fiscal stimulus on top of it, it's the same thing. It's just kind of stagnant economy. The economy will not do well in the face of the tariffs, but it will be offset by the fiscal stimulus. Markets may like it initially, particularly if yields come down a little bit out of fear before that ultimately gets implemented. But anyway, I think you get it. I'm kind of rambling at this point. From our notes this morning, I'll just share one with you. The Purchasing Managers Indices that S&P Global does came out this week, and U.S. manufacturing actually surprised me a bit, but wasn't such a surprise when I got into the details a bit. Actually was better than expected in expansion mode. Now, the ISM's, Institute for Supply Management Surveys, the latest, have manufacturing in recession. But here's from the S&P survey. Manufacturing and services composite rose to 52.1 from 50.6. Anything above 50 means that the sectors are expanding. Both components higher month on month. The former rising to 52.3, that would be manufacturing, from 50.2, and services at 52.3, rising from 50.8. So here's some commentary. This is Peter Bookvar, by the way. The manufacturing improvements seemed all about front-running tariffs. And this is from S&P. The biggest positive contribution came from inventories, of course, if you're front-running tariffs, which rose to the greatest extent recorded since the survey began in 2009. Employment, on the other hand, fell for a second consecutive month. Input costs rose at the sharpest rate since August of 2022. The latest rise in output prices was overwhelmingly linked to tariffs, having directly driven up the cost of imported goods or caused suppliers to pass through tariff-related cost increases. Export orders continue to fall, dropping especially sharply for services excluding the pandemic. The fall in exports of services was the largest recorded since comparable data were available in late 2014, and that would be travel-related services, folks coming to the U.S. Service sector payrolls were trimmed for the second time in 4 months. Charges levied for services rose to the greatest extent since April of 2023. Business confidence has improved in May from the worrying slump in April, with gloom about prospects for the year ahead lifting somewhat, thanks largely to the pause in higher tariff rates. However, both sentiment and output growth remain relatively subdued, and at least some of the upturn in May can be linked to companies and their customers seeking to front-run further possible tariff-related issues, most notably for future tariff hikes after the 90-day pause in July. Don't think we're going to get those, folks, if the market continues to punish the threats. The overall rise in prices charged for goods and services in May was the steepest since August of 2022, which is indicative of coming consumer price inflation moving sharply higher. So that, again, speaks right to my opening monologue there about the tough spot that we're in. Okay, so let's just dispense with that and go to the charts. So we looked at what Treasury yields are doing. Here's zooming out a little bit. You can see they've moved up quite a bit. And I've shown you before, right? When we start getting up into this area over the last year or two is right when stocks begin to decline. Speaking of stocks, here's that S&P 500. We were doing this about a week ago, and I said we've got this 200-day moving average, and we've got this gap to fill right about here. And I said I'd be surprised if we don't fill it. You can see that we're getting really, really close. The market today is finding support right on that all-important 200-day moving averages. You can see the MACD is rolling over. This is the indicator's sell signal when the white line drops below the red. I don't put nearly as much weight on that, frankly, as I do the divergences. Remember, right here, we were pointing to a bottom in the market. We were calling for it, actually. And I was pointing to these very bullish divergences. So we don't have any bearish divergences here just yet. The way that would happen is if the market got a bounce back up to this level, but we didn't see it in the underlying momentum. Remember, I said we were overbought, and we tend to come off of overbought levels, and that's exactly what's happened. So pretty much what I was suggesting a week or so ago, if I recall exactly what I was saying, is starting to show up right here. The NASDAQ saw a bigger gap right here, and again, and I still mean it, I'll be very surprised if we don't ultimately see this gap get filled. Whether this downturn turns into that or it happens over the next few days or weeks, of course, that remains to be seen. Right now, it pretty much falls in line with the 200-day moving average. I would expect any decline to get abruptly stopped right there, either consolidate before it moves higher or consolidate before it breaks down through there, unless it's more news like today and we just get a massive gap right through that. Oh, and then if this, it's kind of looking like an island reversal pattern. If we gap down there right now, that is one of the worst, most accurate patterns ever. And I showed you that, I think, on gold, the island reversal that we had there. So folks who are long the stock market really don't want that to play out. Folks, if we really get a recession and we see the typical decline in earnings growth that we get with recessions, we will pierce these lows that we had back in April. If we get a lot of inflation and higher interest rates, and I think we'll at least test that level. Without a recession, that may be as bad as it gets. With a recession, it gets worse. As you can see, still lots of reason not to get cute here with your portfolio. The 10-year, we looked at gold. And remember, I said back in here that if we see some fear next week, so this was at the end of last week, we could see gold get a pop. And makes the chart look a little more compelling. Gold is reacting to fear again. So it is the fear trade right now. And it's also reacting now to its traditional relationship with the dollar. And you can see what's happened to the dollar. I said the other day it wants to go higher. Well, it's just not happening. The traditional school of thought is that tariffs are actually bullish for the dollar. It offsets the effect of the tariff. And I've pointed out to you, there is massive foreign ownership of U.S. assets. And in this world, with what's going on with whether it's rhetoric or what have you, but what's going on with the U.S. relationship with the rest of the world, we are seeing some net selling of U.S. assets in favor of other assets. In that scenario, you're going to see the dollar decline. Now, it's certainly not in favor of European stocks today. European stocks are down as well. But for example, both of our emerging markets funds are actually green on the day today. So other parts of the world are seeing a little rotation today. But we're also seeing some rotation into treasuries. The yields dropping means that treasuries are up. Our long-term treasury ETF is actually up 1/3% this morning. And again, that speaks to the recession risk of higher tariffs, and in this case, just higher threatened tariffs. We will not see 50% tariffs on Europe, by the way. And I think that's easy to say at this point. So, folks, I am going to do a hard stop right there. Hope you have the best of 3-day weekends. Probably won't bother you over the weekend unless we just discover something dramatic in our weekend research. And be back next week. Thanks as always. Take care. Bye-bye.